Joining me now is Rob Morgan, Chief Investment Officer at Sethi and Financial. Also, Robert Waldner, Chief Strategist and Head of Macro Research for Fixed Income at Invesco. Let's start on the fixed income side because it seems relevant given an interest rate decision. A surprise one that seems like it only happens in crisis moments. Did the Fed do the right thing by cutting rates by 0.5% intra-meeting yesterday?
Well, we would normally expect an intermediate cut like this to be in response to tightening financial conditions. And, we have had volatility, but if you look at within the dynamics of the fixed income market, the real yields are very, very low. 10-year real yields now are somewhere close to minus 40%. So, minus 40 basis points. So we don't have what would be a tremendous tightening of financial conditions, it seems to us. This is what's going on in the market is much more fundamentals driven. It's much more about how is this economy going to be impacted by the virus. And, monetary policy works with long and variable lags, and, we don't know. So it doesn't seem like monetary policy is going to be the solution for us for this problem.
All right. So Rob, I've heard this a lot now, Rob Morgan. The fact that the Fed cutting interest rates is not a coronavirus vaccine. So what exactly is the Fed thinking? Fed Chair Jay Powell did say very explicitly that this will help in a significant way with the economy and economic growth and the trajectory. Do you believe him, and why isn't the market responding in kind?
Well, I think, Don, the reason the market didn't respond in kind yesterday was because this Fed has been so measured in its approach. And I don't know how many times we've heard Fed Chair Powell use the term data dependent. So even though a 50 to 75 basis point cut was priced in, the next meeting's in 2 weeks. I think many investors, including myself, thought, okay, they'll gather some data over that couple of weeks, and then we'll probably see the cut. But, for it to happen yesterday was so jarring, it seemed a bit panicky. And I think a lot of investors were saying, what does the Fed know here that we don't know? So I think that's that's answering the second part of your question. Answering the first part of your question, one reason the Fed needs to gather data is because there are a lot of things we don't know. There's a supply shock here. There's a demand shock here. Are people going to stay home and not go make things? Are people going to stay home and not go buy things? We don't have the answers to that. So it's obviously a situation that's going to be evolving. So
all right. Robert Waldner, we know right now, and Cleveland Fed President Loretta Mester, you heard the comments she just made. Elsewhere in that interview and in some prepared remarks she made in London, she also talked about this notion that the market volatility could be a weight on U.S. growth as well. So how much now are markets pricing in a lower growth paradigm or regime in the coming months and perhaps quarters and years ahead?
Well, there's a tremendous amount of uncertainty about how much this growth is going to slow in the next quarter or two. And that's what the market's responding to. And I think what we need to do is go back and look actually at how this has played out in China. And I think there's a very important stuff going on right now in China, which is China's trying to go back to work. Our channel checks say we're probably about 60% of capacity right now in China. And on the ground, thinking that, by middle to end of March, we may be able to get up to close to full production. We need to watch that very carefully, because if after coming through this viral situation, they can get back up to production, that probably has, gives us some guidance of how we might be able to handle through this. Because right now, we really know very little about how this is going to propagate across the economy and how we're going to manage this.
All right, Rob Morgan, last word to you. What's the playbook? What are you doing? Where are you buying? What are you selling? What are you staying away from? And what's the asset allocation look like given all that uncertainty that you just spoke of?
Well, I'd certainly agree with Robert that there's a lot of unknowns here. So given that, I do believe that best stocks are going to be in a trading range. So I've reduced my overweight on stocks to market weight. I do think from a macro standpoint, the pressure is going to be on rates and the dollar to be down. So I think large cap multinationals will do better than small caps. And so I would overweight large cap growth stocks over small cap. As far as sectors, I'm going more defensive, financials, healthcare, and utilities. And then I'm underweighting more the cyclicals, industrials, materials, and energy.